What's up guys, it's Michael here. So in this video we're going to talk about what happened to the Silicon Valley Bank and what can you do to mitigate risk. Before I get into it, please click the subscribe button down below and a like button so YouTube will notify you when I upload a new video. So I'm not going to delve into the more advanced stuff on why they went bankrupt or how they went bankrupt or why this might end up like the year in 2008. But I'm here to tell you that is why do people keep a lot of money in the bank in the first place, and why in this channel you should always diversify your portfolio. So the first thing you got to know is what happened to the bank, because banks itself, they're there to loan money out. And how did they make money? They had money from the Treasury for the United States that backed them up, and they take the money, loan out to other people in interest. The money they make is what you pay them back in interest, and that is how this whole system works. But what gets me is there are some people, or in this case, a lot of people, keep their money in a bank and try to use it as investment, or they don't invest at all, which I do not recommend. If they don't invest at all, then you have money that's sitting there. You're technically losing value in money because of inflation. Because if your money sits in there, you lose about 1% to 2% a year based on inflation. Because the banks don't pay enough, is their interest to pay you back what they earned. They actually don't even make enough themselves. That's are always in financial trouble, or they, most of the time, let's say in other cases, like back in 2008, they loan out way too much to people who couldn't pay it off. They end up getting screwed. So first, you gotta understand is if you're gonna put money in a bank, you gotta understand a couple things. Mainly, the first thing is where the bank can help you out or not in getting loans, providing you money, providing you goods and services. Like let's say, for example, you have identity theft or fraud. So those are like the number one key factors in providing you that goods and service where you use their bank. But the most important thing is you got to know is FDIC insured bank. So there are banks that have something called FDIC insurance, like back in 2008, when back then the FDIC insured was $100,000, meaning if you put $100,000 in a bank or less, they'll insure that you will get it back based on what the government insures, which has been proven to work. It place trust in the back of the bank. If too many people withdraw at once, for example, a Silicon Valley Bank, they go bankrupt because all the money they don't have it in physical cash right now. They loan them out to other institutions so they can make money from them when they're paying them back. So it's to prevent a panic withdrawal, like let's say the one in China, that one Evergrande situation, because people have really little trust in government. Over here, the trust is a lot stronger. And in this case, so what can they do right now to mitigate the situation for most people is don't keep more money than the FDIC insured. So before it was $100,000 in 2008, and now it's up to $250,000. But in my case, and what I see is if you're putting more than $250,000 or even getting close to that number, that means you're not investing enough. Personally, I think you're not investing enough. Like, why have so much money sitting around? The only time you have that much money sitting around if you're making a massive purchase. For example, if you need to do like a bank transfer, international wire to another institution or business you're trying to invest, then of course, so what's the best way to transfer it? I mean, you're definitely not going to use cryptocurrency. You'll put your money, a massive amount of money in a bank that go over FDIC insured amount because you're only keeping there for about a week or less. Take that amount, then you basically wire it over to whatever place you're trying to do investments or do a massive purchase. For example, if you're buying Pagani, buy a Bugatti, or maybe you're buying a business, you're buying a car wash business, and you need to offer massive amounts of money, then you have someone to insure that transaction. That's what the bank is for. In some cases, some people use third-party lenders, third-party loaners, or they might pay in cash, but a lot of people just use the bank. Just go to the bank, put the money in there, wire it over directly to another person's bank account, and take the money out. So in this case, the people who are really afraid to have more, like way too much money in there, or maybe they caught up in this freak accident, that's, it's really unfortunate. But for the people who have like under $250,000 in there, you shouldn't be worried. You should be able to get your money back because FDIC insured, because the government promises. And in this case, they're able to keep their word majority of the time. And back in 2008, they kept their word. And in this case, even they raised that number to an even higher amount, which is nice for basically nearly everyone, but should you be really keeping that amount of money in there? All that money amount, like $250,000, let's say you keep on average around $50,000 in a bank. That 50 grand, what is it doing in there besides? If you're using it as emergency money, let's say you make over $1 million a year, you have $50,000 in a bank, then it's not really a big deal. But let's say you make like $100,000 a year and you have nearly $250,000 sitting in a bank. Then all that money in there is, you're basically losing money. You're not earning money. You shouldn't taking that money and invest in other resources like real estate, stocks, bonds, crypto, something else that has potentially to make you money. And of course, you should always speak to your financial advisor. It always has a chance to lose money. But the whole point of investing is to mitigate risk. If you don't like to take high risk, then search for options that lower your risk, because money likes to circulate around. It doesn't sit still and stagnate. When you said putting your money is the best way to save up and earn money, in reality, yeah, it sits there. But if you leave money in the bank, then in that case, you actually lose money because it loses its value. It just sits in there. So the best way to do it, and in this case, what happened to Silicon Valley Bank is there was a scare, a lot of people were withdrawing. And in the case of people who kept a massive amount of money in there, well, you shouldn't be keeping that much amount of money in there. I mean, the whole name says it all, a Silicon Valley Bank. Those people in the part of the tech industry, do they really work in the financial institutions, like the money people who deposit in there? But keep in mind, people who use that bank too are investors. So you should expect a lot of people going over $250,000. If this bank, let's say it was Chase, like the one I use, Wells Fargo, Bank of America, if this is like the more consumer bank for more people who use personal use, then that'll be a big problem, because personal use bank accounts, most people are not investors. They just place it in normal bank accounts. They see it every day and just keep their money in there. So Silicon Valley Bank, this is more of a niche bank, in my opinion, because you don't really hear about this type of bank. Like, I never really heard about Silicon Valley Bank until made onto news. And when I took a look into it, I found it really interesting. This is a bank for investors coming in and invest into small tech companies. As for how they got into financial trouble, that will be uncovered later on down the line, because right now the SEC is coming in, all the other investigations are coming in. But keep in mind is never keep your money more than FDIC insured amount in an insured bank, because not every single bank is insured. At the same time, if you have more money in a bank than you make in a year, that means you're not investing it and you're not clicking the subscribe button down below. And most importantly is you should be at least doing some type of investments and just letting your money sit there and degrade over time thanks to inflation. That's it for this video. I hope you guys enjoy it. Please like, share, and subscribe. And I'll see you guys next time.